Recently, I heard about this farmer in South Trinidad who never had an account in a bank, never borrowed from a bank, and he was told by a friend that banks are giving loans for farmers. So he went in and said, I want to borrow $1,000 because I want to plant some dash-ins. And the banker asked, do you have any collateral? And he said, what is a collateral? It's something that we can keep as a security against the money that we give you. So the farmer said, yeah, I have a cow and old 1970 truck, pickup truck, and the banker said, okay, we will give you $1,000 against those as collateral. Within 3 months, of course, the farmer did very well, and he came back to the bank with a wad of cash and pulled out the wad of cash and said, okay, here is your $1,000 that you lent me plus interest, whatever you charge me. And the banker looked at him and said, wow, this is great, and what are you going to do with the rest of that money? And the farmer said, I'm going to put it in my pocket. And the banker said, why don't you give it to us, and we'll keep it safe for you, and we will invest on your behalf and give you a good return. And the farmer looked at him and said, do you have any collateral, sir? So we are getting better at this, and we are hoping to get a better at banking itself. But given where banking is going, we may have to ask them for some collateral. What I would like to do this morning is to share with you some research that we have done at the TTIFC, which is the Trinidad and Tobago International Financial Center, on the whole aspect of capital market development and how that is likely to influence the economic growth and diversification of Trinidad. And I will share with you some research that you may find very useful in terms of your deliberations today. First of all, let us understand overall the context in which we are operating as an economic environment, or what we are calling as the ecosystem of the financial markets. So in a very simplistic way, the ecosystem of a financial market has principles of capital users, those are the borrowers, and then you have the capital providers, the investment banks or pension funds and things like that. And in between, in order to intermediate between the users and the providers of cash, you have financial intermediaries like the banks, brokerage houses, and things like that. And they use certain financial instruments to do this intermediation process, either loans, bonds, or equity share capital. And in order for all of this to happen, there are some market enablers. These include things like market infrastructure, like stock exchanges, central depositories, credit rating agencies, like Wayne spoke about. Then you have the legal and regulatory framework that enables a bank to ensure that whatever collateral that you have given them, they can actually move on it if you default on the loan and things like that. And thirdly, you have the whole aspect of investor education in order for people to be able to understand how to borrow, how to invest, and things like that. So that overall is the ecosystem that we are working with. So we started by asking ourselves, what are the greatest gaps in this ecosystem that makes it difficult for the users of capital to be able to access funding from people who have the capital. And there is a lot of friction that is involved, and that creates a higher cost for the capital that we use. And the second question we asked is, which of those gaps are actually addressable by an institution like TTIFC? So I'll give you some insights in terms of what we found. The first thing that we found was that in terms of users of capital, the cost of funding for the capital that they were accessing was not in line with the actual risk that they have in their companies. To give you an example, recently there was a company from Suriname that came to raise some capital in Trinidad and Tobago. And the rate at which they were borrowing was the same at which a AAA company in Trinidad would borrow. And this company didn't have any credit rating. It didn't have any background in terms of understanding what this market is all about. And yet, investors were willing to lend money to this institution at the same rate as a AAA company in Trinidad. And if you look around, you will consistently see that the rate at which people borrow has no relationship to actually the risk at which they are borrowing at. The second thing that we found was that as far as capital providers are concerned, they are awash with cash. And many of you in the room will be aware of this, that recently when the government raised a bond issue for $2 billion, it was oversubscribed 2 times, and they had to upsize the bond to about $2.5 billion. 2 of our major financial institutions today are sitting on $8 billion of cash without a possibility of investing it in any productive asset in the near future. So on one hand, we have a huge amount of capital that is available, and on the other hand, we don't have enough credit that is available for the private sector. So there is some problem somewhere, right? The third thing that we found was that in terms of risk-taking and risk mitigation, the intermediaries are not in a position to be able to transmit that risk information transparently between the providers of capital and the borrowers of capital. And the second thing in terms of the financial instruments is that there aren't enough actual instruments that enable to transfer that risk in a way that enables to cover the risk that is taken by the providers of capital as well. And trading in the local stock market, as you know, is at best incipient, and there is a lot of need for regulating or increasing the activity on the market itself. And lastly, in terms of the data on borrowers, there is only a 46% penetration of by the credit bureau in the marketplace. So there is not enough information that is available about the borrowers as such. Overall, there are some frictional elements between the various things. But the most interesting thing that we discovered was that Trinidad, among 185 countries, ranks 23rd as far as ease of getting credit is concerned. That means you can actually get credit very easily in Trinidad and Tobago because there is so much of cash. But when you start to dig deeper as to who can actually get the credit, like the farmer example, if you have collateral, you can get as much credit as you want. But on the other hand, on the right side, if you really look at it, this is a survey of experts. And they were asked in terms of, is there sufficient availability of capital for the following? Equity funding, there was only 30% who said, yes, there is availability of capital. But when you ask about debt funding, there was about 66% who said there is enough capital for debt funding. So the market is predominantly a debt market, and there is very little capital that is going into really growth-oriented aspects of the economy. In other words, we are spending or putting more and more money into places that are already successful and already doing well, but we are not putting enough money into those sectors or those companies or those industries that are going to create the next industry. What is the next point, Lisa? What is the next gas industry? We are not putting enough resources behind that. And that was the insight that we found in this one. Now, when you look at the domestic credit to private sector itself, you again see that the 39% of GDP is what we have as domestic credit available, as compared to, let's say, in Singapore, where there's 110% of credit available as a percentage of GDP. And when you look at bank credit itself, only about 60% of bank deposits is actually lent as credit to the private sector. The rest of it is either in the reserves or in investments, in government bonds and things like that. So the real multiplier effect that a bank is supposed to create in creating a vibrant economy is not happening as much. So when you compare it with, let's say, Chile, which has 144% of bank credit to the bank deposits. So that is really creating the multiplier effect of a bank. Similarly, when you look at the bank return on equity, now here is the best news for bankers, and I'm sure Ms. Kumar will agree with me. Trinidad and Tobago and the Caribbean is the most profitable territory for any bank to operate. The return on equity in Trinidad and Tobago is 17% on an average across all the banks. And Jamaica is the only one that does better than us, 21%. No wonder the Canadian bankers just love the Caribbean. And it is not just for the sun, sea, and sand. I can assure you that. What causes this kind of a return on capital for them? Obviously, the lending to deposit spread. And again, as you see in Jamaica and Trinidad, it's 14% and 8% respectively. This is the difference between the interest rate that you get when you put your money into the bank and the interest rate you need to pay if you need to borrow from the bank. Very simple. And that is how banks make money. And I used to be in that industry, and I totally understand that, and I greatly appreciate it because people who work in that industry end up being quite well off, so to speak. I wouldn't go too much into every one of these details, but the broad message is that the risk premium that the institutions command on the credit that they lend is significantly higher, disproportionate to the actual risk that is taken. And that is where institutions like Carrick Risk come in to be able to translate that risk in a more tangible manner. Now, when a bank or a financial institution lends money, there are two key things that they consider. The first one is what is called as the probability of default. That means when I lend money to you, what is the likelihood of me getting back that money? Or what is the likelihood of me not getting back that money? The second is loss given default. That means if the loan goes into default, how much money can I actually recover based on the collateral that I have and all the supporting materials that I have to cover the loan. Now, when you really look at the probability of default, there is a huge asymmetry in terms of information. So when a banker evaluates a credit, he pads up more and more premium, as Wayne explained, in order to cover himself from the probability of default, because he is not very sure about what the credit quality is, in fact, underlying. And this is where a credit rating becomes very important, because that gives you, in an objective manner, what the likelihood of default is of a particular loan or a credit. So in Trinidad and Tobago, for instance, the private credit bureau covers only about 46% of individuals who have a relationship with the bank. So as far as private credit is concerned, it's very difficult to get full information about it. And as far as loss given to default is concerned, the recovery percentage for a loan in Trinidad and Tobago is 18%, as compared to, let's say, even Jamaica, which is about 65%. That means if a bank has lent $100 and that loan goes into default, because of the weak collateral documentation or ability to enforce the documentation, the ability to recover that is only 18 cents on the dollar, as they would say. So this naturally makes the banker very, very averse to risk, and naturally they expect or want excessive collateral to cover themselves. Because we need to appreciate that they are also in the business of managing risks, and they need to cover their risks by ensuring that they have full collateral. And the reason for that is the very low recovery rate that they suffer. Now, the answer to this problem is typically to shift the market from a very bank-centric loan-based market to a more market-centric market, where borrowers are able to go to the market directly through intermediaries like brokers and even banks and borrow directly. And that way, the bank is able to spread the risk across many, many individual investors, and the borrower is able to raise the capital at a much more competitive rate because the risk is spread over a lot of people as well. But if you look at the bonds that have been issued or debt securities that have been registered with the the Securities Commission over the last 10 years, you see that that has really, not been consistent over the years. Let me quickly go to the solution side. When we did this research, what we discovered was a very interesting thing. Trinidad and Tobago has many institutions that are required to create an efficient capital market. We have a stock exchange, we have central depositories, we have credit rating agencies, we have a credit bureau, we even have a mortgage bank that is supposed to create secondary market for mortgages. And we have mutual fund institutions like unit trusts and pension funds. Yet, it's like we have built all these beautiful highways and nobody is actually driving on them. So we have a rating agency, and Wayne will bear this on me, but we are not using it to the full extent. So we have a 6-lane highway and we are only using 1 or 2 of them. Similarly, the stock exchange and the central depository. We have the ability to actually do transfers between the stock market here and the stock market in Jamaica and Barbados. And yet, there is hardly any transfers that happens across that highway. So it's a very strange phenomenon. So why did we build this highway and in terms of the creative capacity and not using it? So that is the key question that we are trying to find the answer to. So what we did was basically, we said, look, Trinidad cannot be the only one that is facing this kind of situation. There must be other countries in the world that must have faced a similar situation at some point in time. So we went and did a number of case studies. And this is what we found. And I'll go through some of these very quickly. On the capital user side, one of the biggest things that we found was that the way they unlocked the market and shifted it from a bank-centric to a market-centric model was the greater use of credit ratings. That was the first thing that we found. And in India, for instance, SMEs get 75% of the rating cost subsidized by the government. And that enables the SMEs to be able to access funding at a much cheaper rate. In the US, for instance, shelf registration is a normal course of business, 144 Reg S and all that. It takes quite a long while, as many issuers will say, to get their issues registered with the SEC. So we are trying to encourage the SEC to move towards a shelf registration process so that issuers can register ahead of time, and then as and when they need, they utilize the shelf-registered issues to issue their funding. Credit guarantees are also very popular as well. But more importantly, in terms of the size of the market that we have, and as I said, we have a significant amount of cash that we are sitting on, we are a very small island. We are a very small economy. And if we really want to protect our long-term interest and hegemony, we cannot rely on investing only in Trinidad and Tobago. We need to find alternate investment opportunities outside as well, because we cannot have enough opportunities for all the resources that we generate here. And therefore, the limit that we have on the pension funds in terms of 20% maximum investment outside is something that we need to look at, because by constraining them, we are actually creating a very risky situation of concentrating all the investments in a small island when our own risk needs to be diversified away. So that is a major aspect that we came up with. But what interested us very much was the Luxembourg model. And what we are now trying to do is to see how to create the Luxembourg of the Caribbean in Trinidad and Tobago. What is the Luxembourg model? In the 70s, as some of you may know, Luxembourg was very much reliant on coal and steel as their primary industries. Now, given those industries were on the decline, they needed to find alternative revenue streams, and financial services became their natural choice because they were very centrally located in the European Union. And initially they started off as a tax haven, but very soon they moved towards full-fledged financial transactions. One particular instrument that they used was what they call as UCITS, or Undertaking of Collective Investment Transaction Securities. This is an instrument through which any mutual fund that is registered anywhere in the European Union can be registered in Luxembourg, and they can be actually traded transparently across all the markets. So given Trinidad's position as a virtual financial hub of the Caribbean, and given that we have excessive liquidity, we have an opportunity to create a platform or an instrument or a framework through which we can trade any security across the region so that we are able to invest our own capital and also create a platform for the regional sovereigns as well as companies, not only in the CARICOM sector, but even in the wider ACS sector, to be able to come and raise their funding here. And that will enable us to also diversify our own investment options as well. So those are some of the opportunities that we found when we did the analysis of the various markets. And one of the key things that we are looking at is how to translate this into an actionable set of agenda. As Indra has put it, this is a solutions agenda that we want to talk about. So what we have done is to create a roadmap for ourselves as to what needs to be done. Because many of the solutions that we talked about, many of the issues, are not new. There have been many papers written, there have been many committees that have been set up to look at these things. So question is, how do we translate this into some actionable items so that we see some results? So we are looking at, as a priority, 6 key items that we are going to be focusing on. These include incentivizing for greater use of credit ratings by SMEs and other companies as well. Rationalizing some of the foreign investment restrictions, and more importantly, creating a systematic agenda for the government to borrow through the bond market at specific intervals, so that someone who is sitting on some investment does not want to hold on to it because he is not sure what next will come. So if there is a published agenda, then he can say, okay, in 3 months, government is going to come borrow 500 million, I can move my equity into that bond or things like that. So there is a clear agenda that they can work with. We also want to work with auction systems. For instance, as you know, government actually borrows from the market through the central bank auction system. We are talking to the central bank to see how we can actually open this platform to even private sector to be able to borrow through the auction system so that there is a transparency of pricing that is readily available. So those are some of the initiatives that we are working on at the TTIF.